All right, welcome to Markets 101. We're going to be talking about central banks. All right, now it's always fun to go out and just do a Google search of central banks. Because if you do, you are going to find conspiracy theory after conspiracy theory. And I'm telling you what, it's actually pretty funny. I didn't know that the Illuminati is actually running all the central banks of the world. I literally just found that out today. It's fantastic. I never knew that before. All right, now obviously, if you want your conspiracy theory, go out and get it. We're not going to be talking conspiracy theory here. We're actually going to be talking actual economic theory. So we're going to be discussing the history of central banks, how they work, what they do, and how they affect assets like currencies and stocks and bonds. All right, let's do a quick history of central banks. All right, the first central bank was actually the Swedish Riksbank. And I'm sure I did not say that properly, but that is the best I can say it. It started in 1668. And it basically was set up, and the government said, hey, we need you to lend us money when we need it, because we might need some money. And if we don't have any bank that lends us money, then we could be out of luck. So they set up this Riksbank, and this was the very first central bank that was set up to fund the government. About 25 years later, the Bank of England was created. And the Bank of England is still in existence. So the Bank of England is the oldest central bank. But it was actually still set up as a private bank. So this private bank was set up, and its job was to purchase government debt. So its job was to basically fund the government, but it was still a privately run bank with private investors. It was still a regular for-profit bank. But the government had an agreement with this bank that, hey, when we need money, you need to give it to us. So this bank always made sure that it had money to give the government, especially in times of stress. That was the sole purpose of it. Well, in the early 1900s, the United States Central Bank is called the Federal Reserve, or the Federal Open Market Committee. It's a division of the Department of Treasury. Well, the FOMC, the Federal Reserve, they decided, you know what, we're going to do things a little different. And so the Federal Reserve was actually the first non-private bank. Sorry, the first the non-public bank, meaning that it was owned by the government. So this government entity was set up to be a government bank, and it would be in charge of lending money to the government, but it was the government, but it was independent from the government, but it was owned by the government. Okay, good. I'm glad you understand that. All right. Maybe you didn't understand that. I know I said it and I didn't understand it. But it creates this government bank that is separate. It is separate and independent from the government, but it is still 100% wholly owned by the government. But its job is to lend money to the government when it needs it. I know it's very silly because you're saying, wait a second, it is the government. Well, they've set it up to be separate. And we'll talk about that a little bit more. So that was the very first central bank that was actually a government-run institution. Pretty soon, within the next 30, 40 years, pretty much all of the countries in the world had these government quasi-entities that were their central banks. The United States was also the first country to leave the gold standard. Now, if you don't know what this is, you don't really need to know. Every so often I hear about a politician wanting to bring back the gold standard. It's a little ridiculous here. But basically, in the world of currency, the very first currency was made in the Netherlands. And basically what it was called a bank note. So if you had 1,000 gold coins in the bank would give you a bank note. Because if you wanted to go buy something, you didn't want to carry all 1,000 pieces of gold on you, because if you got robbed, it was gone. So the bank gave you a bank note, and you would take it to the person that you were going to buy something from, and that person would take that banknote and go to your bank and get the money. So basically, it worked like a check. Now look, I know if you're under 30 years old, you may not even know what that is. My kids have no idea what a check is. They've seen them before. They might know the concept, but I know for a fact they have never used one. Okay, but you know what? They have definitely received checks from their grandmas and grandpas. They've received the checks and they've gone to me and be like, Dad, what do I do with this? I'm like, okay, well, you write your name on the back. And they're like, why do you do that? And I'm like, I have no idea. It's your name is on the front. Why do you have to sign it on the back? Anyway, they know that they can go in and take that money to the bank and they'll put money in their bank account. But it was always backed by something of value. The gold standard means that every time a government wanted to print more money, they had to have gold and silver in their coffers in return to print more. And if they didn't get more gold and silver, they couldn't print more currency. This meant that the currency always had some value behind it. With the United States, they left that and they said, you know what? We don't need this anymore. We just want you to trust that this piece of paper has value. Now, it sounded crazy at the time, but guess what? Everyone was okay with it. And pretty soon, all the other countries, they followed them. And the only country that still follows it a little bit is the Swiss National Bank. So the Swiss currency is still backed, but only by about 20% of the gold standard. So these central banks, they were basically in charge of creating the money supply. How much money was going to be printed? And what they also do, they make a lot of decisions for the country. So as we talked first, they control the nation's money supply. They decide, are we going to print more money or are we going to shrink the pool of money? They also act as the government's lender, meaning the lender of last resort. So we actually saw this go into action in 2008. So if you remember, in 2008 when the U.S. was really coming apart, Lehman Brothers collapsed, other banks were collapsing, and the Congress came up with a program called TARP, the Troubled Asset Relief Program. So basically all these banks had a lot of crappy loans on their books, and they needed to get them off of their books in order to survive. So what happened was the Federal Reserve and the U.S. Treasury, they stepped up and they said, hey, we've got money, we'll buy these assets. Well, wait a second, they didn't have money. The FOMC doesn't have a big bank account. What did they do? Oh, they printed money. They printed $1 trillion almost. I think it was like 800 billion, but they printed almost 1 trillion. In the end, the U.S. Treasury printed $4 trillion out of thin air, and they used that to buy all of these troubled assets. So they were the lender of last resort. They came in and they said, okay, look, we'll print more money, we'll give you money. And that really helped the United States recover much faster than other countries, the fact that they did that. So this is really the purpose of the central bank. And they also were going to set the official interest rate. So the central banks have a lot of power behind what happens in an economy because they can control the money supply. If they want there to be more wealth in a country, well, they can actually print more money and distribute that along the population. Now, if they do that too much, they run into what happened to Zimbabwe, where their currency went to zero. So this is something they're very conscious on. They want to have the right amount. If they're a little bit worried that the economy is too hot, well, they might shrink the money supply. They might actually take money out of circulation, and now there's less money to go around, so there's not going to be as much investment. The other way that they can really affect a country and its economy is by setting interest rates. So the central bank sets the interest rates that people can that people can borrow money from the government for. And this is called the discount rate. And this is the rate that banks interact with the government. Now, when banks go to the government and borrow money, they're going to probably pass on that interest rate to you because let's say this month they can go borrow money from the government for 3%, they'll probably lend it out to you at 6%. Well, if next month the government charges them 4% to borrow money, they're going to pass that on to you where it's going to be 7%. So the central banks, they're going to set the interest rate, and that interest rate is going to flow through to all of the banks. Now, this is a big deal because interest rates set a lot of things. Number one, it sets when you go and deposit money at a bank. If interest rates are higher, you are going to earn a higher rate of return. So they may say, look, if you put your money in this bank, we're going to give you 2% a year. Great. Now, if you go to a bank and you say, I need to get a loan, I want to buy a house, I want to buy a car, I want to buy an investment, they're going to make a loan to you, and they might make that loan at 5%. So that's how banks work. They borrow money in at 2% and they loan it out at 5%. Well, what if the government raises interest rates on what the banks can borrow for them for? Now, when you go to get a loan, that loan is now 8%. Now, that may discourage you from buying a house, from buying a car, from making an investment. They're trying to slow the economy down. So they use interest rates to raise and lower economic activity. So as you can see, central banks have a lot of power. They can increase and decrease the money supply. They can increase and decrease interest rates. Now, when it comes to the world of currencies, this is actually very important because we are dealing with money. When you are trading currencies, you are trading money. And money that you have that sits in a bank, which is exactly what you're doing in currency trading, earns interest. It earns interest. And if you take a loan out of money, you have to pay difference. So in the world of currency trading, you are always long one currency and short the other. You cannot just buy the Australian dollar. If you are in the United States, you are making a currency transaction from United States dollars to Australian dollars. So you are in the Australian dollar, US dollar cross. Let's take this example where you wanted to buy the Australian dollar, Japanese yen cross. Again, you cannot just buy the Australian dollar. You must buy a currency cross. You must be exchanging one currency for the other. You're buying one currency and shorting the other. And when you're short, you're borrowing. So if we take a look at what's happening in this example here, the Australian central bank rate, you can see, is 4.25%. So if you are long the Aussie dollar, that means you have bought the Aussie. You own Australian dollars, and those Australian dollars are in a bank account and they are earning interest. Because the interest rates in Australia are 4.25 and the interest rates in Japan are 0.10, you can see that you sold or shorted the yen. You have borrowed Japanese yen. So you have borrowed money from a bank and you need to pay interest. But because the amount of interest you're earning is so much higher than the amount of interest you're paying, you are actually going to get a currency swap. So what happens is every day you hold this position, you will earn money. You will earn the net income difference. This is how the currency world works, currency swaps. There are some people that will trade only for currency swaps because they'll say, look, I'm going to go get 4% by just buying the Aussie dollar, Japanese yen. So if more and more people do that, what happens? The value of the Aussie goes higher because there's more people buying it. The value of the yen goes lower because there's more people selling it. And what happens is this will get even wider. Back in 2008, there was about a 10% spread between the Aussie and the yen. People were flocking into these for the spread. So as you can see here, when you understand how these interest rates work, it is very, very important in the world of currencies to understand interest rates. And it's also very important to understand that when the Australian Central Bank announces that they are likely to lower interest rates in the future, this is automatically going to make the value and the perceived value of the Australian dollar worth less than it was before. If the Australian Central Bank announces they're going to raise interest rates in the future, all of a sudden people are going to want to buy that currency because it's going to pay more in a currency swap. These central banks have a lot of power on what happens with the value of currencies. They can increase the money supply, which technically if there's more of something, it's worth less. If there's less of something, it's worth more. They change the interest rates, and this really affects the swap rates. So if you have a country, a central bank, that is shrinking the money supply and raising interest rates, that currency is most likely going to be going higher in value. Again, understanding how all of these economics work and how it pushes currency values around, very important to being a trader. Thank you.